Let us now look at a summary of this reading. This reading is very important from a testability perspective. We need to recognize that when a company makes investments, there are different categories of investments. The most basic investment is an investment in financial assets, where a large company might buy some shares of another company. The influence there is not significant, and typically when the ownership stake is less than 20%, then we say that the ownership is in a financial asset. But the critical remark or the critical factor to consider is the influence. If an asset or an investment is classified as a financial asset, then the accounting treatment depends on this subclassification. And the subclassifications are shown right here: held to maturity, AFS, held for trading, and designated at fair value. Held to maturity means that on the balance sheet, the asset is shown at historical cost or amortized cost. Any unrealized gains and losses are not shown anywhere. If there are some realized gains or losses, then they are shown on the income statement. If there is any interest income, then that is shown on the income statement. With AFS, the asset is shown at fair value on the balance sheet, and any unrealized gains and losses go through other comprehensive income. With held for trading, the asset is shown at fair value, and all unrealized gains and losses flow through the income statement. Designated at fair value has the same treatment as held for trading. Then we talked about investments in associates. This is where the investing company has a significant amount of influence over the investee, and that usually means a 20% to 50% ownership stake. With joint ventures, you have two or more venturers who have joint ownership or joint control of a particular entity. The stake of each venturer can vary. You can have two entities with a 50% stake, or one can have 30%, the other can have 70%. So the percentage or the amount of interest can vary. The important thing here is that for both associates and joint ventures, the appropriate accounting method is the equity method. In equity method, the share of income is recorded on the investor's income statement. So this is a one-line entry, and the value of the investment is equal to the beginning value, that's how much was paid initially, plus the share of profit minus the share of dividends. This is called one-line consolidation because we have one line on the balance sheet which says investment in associate, and we also have one line on the income statement which says income or earnings from associate. Then we can have business combinations where the investing company has control over the operations of the investee. This generally means an interest of greater than 50%, and the accounting method used here is the acquisition method. With acquisition method, there needs to be 100% consolidation. So all the revenue of the investee needs to be brought over, all the expenses need to be brought over. On the balance sheet, all the assets need to be brought over, all the liabilities need to be brought over. The little caveat is with regards to goodwill, and there are two subcategories. One is called the full goodwill approach. One is called the full goodwill approach. The other is called the partial goodwill approach. From a testability perspective, there are two major categories of questions. One category of questions involves recognizing which method to use. So you will be told that there is significant influence, and you need to then figure out that the equity method is the right method. And then the other category of questions involves saying that if there is subjectivity, let's say there is 50% control, then a company might have a choice of using the equity method or the acquisition method, and you need to understand the impact on financial statement elements and financial statement ratios of the accounting choice. The accounting choice being whether to use the equity method or the acquisition method. So what happens to the various accounting elements and then the ratios? the assets will be lower with the equity method and higher with the acquisition method. Why? Because in the equity method, we are looking at net assets. So whatever company we are investing in, we are bringing in the net asset value, which is assets minus liabilities. Whereas in the acquisition method, we are bringing over all assets. So the asset value will be higher. Then there is a subtle difference between partial goodwill and full goodwill, where in the full goodwill method, the asset value will be slightly higher or higher relative to the partial goodwill method. What about liabilities? With the equity method, we are bringing over net assets, so we are not really changing the liability part of our balance sheet. Whereas with the acquisition method, we are bringing over all the liabilities of the acquired company. There is no difference with regards to liabilities between the partial goodwill and the full goodwill method. What about equity? Equity goes up again by net assets. So net assets is equity. So the increase in equity is equal to the net assets coming over. And the same effectively happens in the acquisition method. In the acquisition method, you are bringing over all the assets, all the liabilities. So the change in equity is again equal to net assets. But there is a subtle difference between the change in equity with the partial goodwill and the full goodwill. With full goodwill, you are taking the entire amount of goodwill of the acquired company. So the equity number will be a little bit higher here relative to the equity number with the partial goodwill method. The equity number in these two scenarios, equity and partial goodwill, will be the same. What about revenue and expenses? As far as the equity method is concerned, we are just bringing over the profit. So we are bringing over the net effect of revenue and expenses. Whereas in the acquisition method, you are bringing over the entire revenue and you are bringing over all the expenses. So what happens to ratios? Actually, before ratios, what about net income? Net income is the difference. So net income is actually the same across all methods. And now coming to the ratios, net profit margin. The net profit margin will look best with the equity method because your net income is increasing the same across all methods, but revenue is not increasing in the equity method. However, revenue is going up in the acquisition method. So if the numerator is going up by the same amount across all methods, but the revenue is not changing in the equity method, then obviously the impact on the net profit margin will be best with the equity method. What about leverage ratios? As you know, leverage ratios become better with lower levels of debt, or more favorable with lower levels of debt, and worse with higher levels of debt. With the equity method, you are not bringing over any debt. So here you have the most favorable ratios. What about a comparison of the partial goodwill and full goodwill? The liabilities or the debt would be the same across both methods, but the asset and equity numbers will be better with the full goodwill method. If that is the case, then the leverage ratios will look slightly better with the full goodwill method. What about return on equity and return on assets? We saw this in one of the questions. Clearly, the most favorable ratios will be achieved using the equity method because your net income is going up, but the assets and equity are not going up. Then between partial goodwill and full goodwill, partial goodwill will be slightly better because the assets and equity numbers will be slightly lower. So this slide gives you a summary of all the important ratios. So that is it. As always, I want you to read the summary, review the objectives, do the examples, and then do all the practice problems, and then also try to do questions from other sources.